The genesis of the online lending space and the explosive growth was really the collapse of the economy in 2008. Banks closed up access to money, especially for small businesses. Their appetite for risk decreased dramatically. So there were lots of small businesses that had limited access to capital, limited options. And really the marketplace responded. Lots of these online marketplace lenders, alternative lenders came into the space, identified the need, and came up with creative, new, flexible products and ways to access capital. So the genesis was really back in the collapse of the economy in 2008. And the growth has accelerated from there. Over the last couple of years, the banks have gotten back into the small business lending space, but they're still cautious. And in that interim period between 2008 and 2013, the online marketplace lenders have really gained a foothold, and they're building on that and developing market share. It's accessible, it's quick, it's flexible. You can go online, apply for a loan, get an answer pretty quickly. You get the money pretty quickly after that, and it's easy. I think there's two elements to it. One is they are very heavily invested in technology. So you access their services and the capital online. So it's pretty quick, open access, and they're pretty flexible. So the open access through their platforms online, but in addition, they have a slightly different way of looking at risk. Traditionally, banks look at risk and look at financial statements, time in business, credit histories, and they combine all of that and they take time to deeply analyze them and make their decision. In the online marketplace lending space, they look at those things, but in addition, things like cash flow, types of businesses. So they combine more data in a broader way to make a quicker decision. It's hard to define one particular area. It varies widely. There are as many answers to that question as there are small businesses. In many cases, it's equipment, it's investing to grow. In other cases, it's getting them through some kind of a short-term capital need. So it really is it's a very broad range of reasons and purposes that they borrow the capital for. We generally think of lending as lending between an institution, an organization, and either a business or an individual. Think of peer-to-peer lending as having no intermediary. It's person, organization A, person, organization B, and then there's generally a technology platform that connects the two. The need for capital with the capital that's available for investing. Mm-hmm. That's peer-to-peer. Think of it as one-to-one or one-to-many, non-traditional, more direct. 2008, because of the economic collapse, banks moved away from lending in a big way, especially in small business. Their standards went up. The amount of capital available through banks went down. The online marketplace lenders moved in. Now what's happened is the economy's improving and the banks are coming back into the market. And what they're finding is that online marketplace lenders are in the space. They are competitive. They've got some tremendous technology, and they've got a slightly different, innovative approach to risk. So the banks now have no option but engage with these new expectations that customers and clients have. Rapid turnaround time, quick decisions, flexibility of products. So the banks have no choice but to deal with online marketplace lenders. One of the major challenges that they have is that there's a tremendous level of regulation in the traditional banking sector, especially after the 2008 collapse. There is much less regulation in the online marketplace space. So there's a significant difference in regulation, which means a significant difference in flexibility, in approach to the small business who needs capital.